into why we did this and what to expect. Before we start, I would like to turn it over to Lisa and Ray, if you'd like to give just a quick hello and a welcome.
Yeah, I'll start. Hi, everyone. Thanks for taking the time to be with us today. We've been working on ForwardProtect for quite some time through conversation with different stakeholders, with farmers and grain companies and insurers and reinsurers. And so we're excited this is our first webinar, so to walk through with advisors. And as always, we'll be, very keen to hear your questions and talk through some of it. But we really think it, fits an important gap that we've seen in the market, especially since some of the defaults that happened in 2021. So we're excited to, this is the kind of first product offering here in Canada. Ray, I'm not sure if you want to say anything, but.
Yeah, I think I would just reiterate a little bit of what Lisa has shared is that, when we launched Agi3, we started with our Agri-Enhanced product, but we had a vision for some other products that we felt were gaps in the market. And this clearly is one of those products that I think both grain companies, grain buyers, and producers are excited about. So we're excited to launch it, and hopefully it's just one of many other products that we'll be able to bring to the market. Thank you.
Okay, thanks. John, I will hand it over to you for the presentation.
All right.
Actually, just as you're bringing that up, just so everybody knows, if you do have any questions, please put them in the chat and we'll do our best to respond to them as we go.
Perfect. All right. Can you see the presentation?
We can.
Okay, perfect. So I've thanks again to everyone here. Thanks for your time. We're going to cover a few things here today. I'm very excited about what we're covering off. It's kind of personal to me because a couple of years ago, I farm a little bit, just enough to be dangerous, I guess. But a couple of years ago, the markets were rallying in the springtime, kind of around this time of year, maybe 3 weeks from now, kind of in that late June timeframe. And I remember I was taking the family for a week vacation. Well, my poor brother was dealing with the spraying, but the market started rallying, and I started contracting into it, forward contracting, right? And it kept rallying, and so I kept contracting. It got to a point where I was, okay, I don't want to contract anymore, but it's a really good price. And so I just stopped. And sure enough, it stayed at a good price. A few months later, a couple months pass. All of a sudden the markets come down, and sure enough, the bushels are there. To be honest, it wasn't even close. There's plenty of bushels, just the way it was. The worry about the forward contracting really left money on the table for me. So it's, very personal for me. I want to go through what we have here. I think it's very exciting what Agi3 has built in terms of a tool to help the industry with forward contracting. So I'm going to cover off a bit on who Agi3 is. Not everybody is familiar with us on this call. What the problem is, our perceived view on what the problem is. I'll talk a bit about ForwardProtect, the mechanics of ForwardProtect, how it works, the sign-up process, and then anytime along the way, you can just put your questions in the chat, and we'll stop a couple times to go through it as we go along here. So Lisa and Ray gave their introductions. So Lisa, background in actuarial sciences and a lot of experience in crop production risk modeling. So from my experience in the industry, I've never met anyone that has this much experience and I would say this much passion for crop production risk management and modeling and those kind of things. So she's really keen on this stuff. She understands it really well, especially in the Western Canadian context. And she's our CEO and day-to-day quite involved in the operation. And then Ray, who you've also heard from, Ray's got his hands in many areas in the ag tech world. And obviously you may know him from his work at Enns Brothers as CEO. So Ray really understands this side from a commercial standpoint. And Ray provides input to the team on a strategic basis, from time to time. So very good team we have here to work with. We're Canadian. Shout out to Teddy, who's the lone American on the team here, but
Mhm.
We wouldn't have a business without Teddy. So, but the rest of the gang is Canadian, east to west coast, from operations, engineering, support, actuarial, across the west. So across Canada. So we're very proud about that, especially in this day and age. Strategic partner, shout out to Definity Financial. Without a partner like Definity, it'd be really difficult to get a product like Agi3, like ForwardProtect off the ground. If you don't have a long-term strategic partner, you're left being very transactional, very year to year in your product development. And for us to really create something that has some power and some legacy to it, we need to build on it year to year. So we're really happy to have Definity in our corner. And they come with a lot of history, 150 years, very big business, billions of dollars in premium. So we have an excellent partner with Definity. I wanted to cover a slide here, just a little bit about Agi3 and kind of what's our ticker, I guess. Really, I would say the biggest thing is our innovation in managing risk. This is something that we perceive as a gap in the marketplace that Ray touched on earlier. It's something that has really been, I would say, lagging for the last number of years. And this is something that Agi3 brings to the table in spades. There's a tremendous amount of yield and data history, soil history or soil parameters, weather history, yield history that's been put together by Lisa and the team, using some pretty sophisticated modeling and unique ways of looking at the data. So it's very comprehensive. There's nothing else out there like it, especially in Western Canada. So this is very powerful and very unique. So we're very happy about that. We can leverage that. Obviously, it's the most important piece when you're trying to put a business together like this. The other very important piece, and I talked a bit about it with Definity, is we need a good backer to take on the risk. Agi3 doesn't take on the risk ourselves. That goes to a Definity, and then Definity in conjunction with their partners decides, what kind of risk are they going to hold? What kind of risk goes to the reinsurance market? So again, those relationships are very critical. None of this works without, the proper modeling and upfront calculations, and then the proper relationships and managing the risk on the back end. So those two are very important. Nimble, I would say, shout out to Kyle and the operations team. We can't, really can't do this without being to add the enhancements, pivot, change, update on the fly very quickly in order to have the proper product market fit. Right, this is critical in our mind, and I think again, from my perspective, I think this is really well done, and it's only going to make things better. Partnerships, we have a number of them right now, and this is something, being a startup, we're on year 3 right now. This is very critical. We're not going to do everything ourselves. We understand that. We need to leverage our technology with partnerships, find people that have an interest in the technology, have an interest in what we're doing, what we're trying to achieve, and how can we find a win-win. So another critical ingredient for Agi3. Then finally, the service aspect. This is something that kind of came about organically as the business, was rolled out, in that with the technology, with the platform, without having the service to go along with that, we really wouldn't have the business moving along with it. So a lot of growers really appreciate, someone to talk to, someone to walk them through how it works, someone to basically help them out, right? So they have someone to ask questions with that's right there. Again, on our portal, you can, in the corner, we got a little text box. If anyone has a question, they can put it in there, and usually within the hour, at the most a few hours, someone's going to get back to you. But generally, our customers have a key point person. They know who we are, and that's very much appreciated. Our core product, I'm not going to spend much time on this. Just for those who don't know, Agi3 is our flagship product right now in the market. We've seen some rapid growth over the last 3 years. It's basically a top up to the insurance products that are in the market. And it allows guys to hedge on their crop yields. There's flexible trigger points. There's flexible coverage amounts. It can be used on pretty much all broadacre crops in Western Canada. So a lot of flexibility. And again, the exercise we go through with growers is where is the gaps? Where is the concern? How do we create some, a product to kind of fill some of those gaps for the right price? It's prairie wide, and it's a yield insurance at a set price. So it's not, we don't get into crop price risk management on this product. It's strictly wheat at $8.50 a bushel. We're protecting you if you get below X dollars a bushel. So that's how the Agri-Enhanced product works. But based on the fact that this is strictly a yield product, based on the fact that there are at times problems with pricing and getting a good price, we feel there's another problem that we can do something about, and that's where we're going with this with ForwardProtect. So what our interpretation of the problem right now is that most grain coming into harvest is unpriced. So this is very ineffective for growers, and it's inefficient for grain handlers, right? Like if a grain company, ideally they have as much of their book forward contracted as possible so that they can manage logistics. If they get a better deal along the way, they can basically trade up for it. So it's more efficient for the grain business. I mean, I'm speaking, everyone knows this on the call, but it's very efficient to have this stuff planned out. Doing spot business all the time is not very effective. Carrying grain over the winter, again, not very efficient. Yes, there can be rallies, but I mean, these rallies, there's a cost in order to carry that grain. And I'm going to get into that. It can be painful. Not all growers follow forward contracts, some do. But for the ones that do, you can be sure, my experience a couple of years ago is there's always a bit of doubt. Am I going to have enough grain to meet that obligation on delivery? Or what am I not contracting because of the doubt on the production? So the pain of these buybacks, and we went through it in a big way in 2021, is it's happening to guys when things are already bad, right? Like if the crop is already in bad shape, and then on top of that you get hit with a grain contract buyout, that's like double the pain. So it's very severe. Growers are very sensitive to it, and there's limited options out there on managing it. So we think we found something pretty cool in what we're bringing to you today. So the cost of being hesitant, I'm just going to go through a few items here. I mean, you have your own prices on this. I'm just throwing, some back of the napkin numbers here. But looking at the cost of carrying grain, we're using a per annum rate of 8%. I think you're, plus or minus probably a point on that. Carrying grain for 6 months at $15 a bushel canola, for example, that works out to 60 cents a bushel. If you're not moving grain at harvest time, you're probably waiting for the next rally, which might be well after Christmas. It could be easily March or whatever it is, right? So on average, grain that is carried, chances are it's being carried for a few months. Grain bin storage. This is not cheap. I have a number of 350. It could be a bit higher, it could be a bit lower, depending on the size of the grain bin, but you add in payments on that. And I'm not even factoring in drying costs. You're right away looking at 35 cents a bushel. Now that would be for incremental storage, right? But for a lot of these farms that are growing, I mean, they're building and they need capacity every year. So this is a real cost. Storage risk, spoilage, theft. Not a lot of theft, but it does happen, and spoilage is real. Taking full advantage of the spring rally without concern. Again, I talked about my example. That's something that there's a material cost. I don't know what it is. Contracting with your preferred grain company. So maybe you want to deal with one grain company in particular or one buyer, but maybe they're $1 a bushel out on the market, right? What if you can, maybe another company has some tools to help you manage the risk a little bit better. But if you can deal with that one company in particular, work with us on something like we're proposing here, maybe that can save you some money. Refinancing. It's amazing. Refinancing always hits when you're not in the best position to manage it, right? So if farmers are move their grain early, have a cash position in the fall, then that sets them up better for those conversations with the bank over the winter time, right? They're sitting better with cash, so they can negotiate some better terms on their refinancing. Again, hard to quantify that, but overall, it's pretty clear that there's, you know, probably north of $1 a bushel in carrying costs here by not moving your grain early. So, you know, it could be variable. Point I'm trying to get across here is there's a material cost. So this is leading us to introduce a product we're calling ForwardProtect. We're very excited about this. It's grain contract insurance that allows a grower to hedge against the cost of grain buyout as it pertains to a rising futures price. It is triggered when a grower falls short on their grain production and the futures price rises from the contract period. We apply an insurance policy on the futures price for that respective contract, but it's only on red spring wheat and canola. For this year, I mean, these crops have very established futures markets. It's the biggest crops in Western Canada. It was, you know, the best place for us to start. Doesn't mean we're only going to stick with these crops in the future, but for this year, this is what we're working with. Again, we're only ensuring the futures price movement. We're not getting tangled up in the basis and what gets done on the basis price. That's between the grower and the grain company. And our product, it's a standalone product. So just because you have, you know, a buyout with the grain company doesn't necessarily mean you have it with us. I mean, our product is based on the futures price, so chances are it's going to correlate. But it is an independent contract. It's strictly between us and the grower. So just showing you diagrammatically what we're covering here. When the price goes up and you have a yield shortfall, that's when this would trigger. So in terms of how this works, like mechanically, growers will still contract as per usual with the grain company or, you know, buyer. Hopefully a little bit more. Growers have 7 days after grain contracts to get a policy with Agi3. So we can't leave this go indefinitely. And the reason is we use the same pricing numbers on the grain contract for our policy. So if the price of canola goes up $1 after you got your grain contract, you know, we're not going to write an insurance policy using the grain contract. You know, if we're talking 3 weeks later, for example, then right away the grower will be in the money per se on it, right? So just to keep it simple for this year, we're doing it within 7 days. Get a grain contract. If you want insurance, put it on within a 7-day period. If the grain price moves a little bit in that window, that's fine. Again, it's 7 days. It can move a little bit, right? But for this year, we're just managing it. If you do it within 7 days, then you're good. Pricing changes. They'll be changing every day. You know, if I show you a price today, tomorrow it's going to be, could be a different price. It just depends a bit on what the grain prices are doing. Agi3 must be informed of any midsummer grain contract cancellations if there's a claim that is imminent. So we're not going to, if, you know, between the grower and the grain company and they're like, okay, I need out of my contract, I'm worried, even though I have this coverage with Agi3, I'm worried about the bases blowing out. We'll work with the grower on that. So basically the grower can buy out of it or can, you know, close the contract with the grain company. But for our policy, we need to know what their yield is at the end of the day. Having said that, best thing again for a pilot, just be keeping us informed on how things are going. Once the contract is closed, we're going to use the price of the contract, the futures price when it was closed, and we'll apply that to the yields at the end of the day, the end of the season. So final settlement will occur when harvest report is provided. So what is not covered? So scenarios without a yield loss, market price decreases, old crop or grain and storage. So we're strictly looking at new crop. So for this year, we're looking at 25, crop that's in the ground for 25. Grade quality or grade or quality issues and non-contracted grain. So we need at least a futures price locked in. It doesn't need to be net price. You can do a futures first, but we do need, has to be contracted. And if there's basis changes, we're not covering that. Again, we're strictly looking at futures price. So just to help with this, I'm going to go through a simple scenario with farmer Fred. So he's got canola crop. He has 1,000 acres, expected yield of 45 bushels an acre, expected production of 45,000 bushels. He's already contracted 22,500. So he wants to contract another 9,000 bushels and he wants coverage on that. The futures price right now is $15. So what we do is we establish a band with that information. So we got a high and a low, and basically the contract amount establishes the low and the high part of that band. So in this scenario, the low part of the band is the 22,500 bushels, right? Which is what he's already contracted. And then he gets another 9,000 on top of that. So you can see on the diagram there, the 22,500 reflects about 50% of the way there on their expected production, which also works out to 22.5 bushels per acre. The high part of the band works out to be at 70% of the expected yield, or 31.5 bushels. So the coverage is within that band, right? So now the coverage calculation, basically we take that band and then we provide coverage up to double the futures price. So if the futures price here is $15, we provide another $15 of coverage. So the max coverage in this scenario is nine bushels an acre times $15 times 1,000 acres. So that works out to $135,000. Now let's say come harvest time, the grower gets 20 bushels an acre. So they're down, and the price on the futures is up to 17. So this is a claim, right? So the claim calculation would be 9 bushels an acre. They've blown right through their full band, and they've actually gone below that, but we only pay up to the max is the band that we cover off. So it's 9 bushels an acre times $2 a bushel, the $17 minus the $15 times 1,000 acres. So it works out to an $18,000 claim payment. So we would make that payable to the grower directly. And then the grower hopefully takes that information and that check and spreads the word in town how great of a hedge he's got on his futures contracts. So I'm going to go into the app right now. And if there's any questions in the meantime, feel free.
John, while you're doing that, I'm just going to send out a quick question for everybody. Just a quick little poll about where you think your growers have already contracted. I don't know, can you see that poll that popped up?
Yeah, I see it.
So yeah, for anybody here, if you could please just answer this one, and we're really curious to see kind of where we're at. Give everybody a few more seconds here. A couple answers in. Obviously, this year with the markets being how they are, it's a little bit out of the ordinary. Okay, last ones that they're coming in. So share the results there. So the majority were at about 20% and a few at 10%. Okay, thanks for taking part in that.
Can you see the fields on my screen? Yeah?
Yeah.
Okay. So this is in our application. It's the same application we use for Agi3. We got a couple fields here north of Regina. Test FP1 and canola. We have little summaries here of the acres by crop. We got some different layers, NDVI, stuff like that here. So what we're going to do is we're going to go to Insurance Solutions. We're going to go, here's the Agi3. We're going to go to Apply Now for ForwardProtect. And here we got canola and wheat. And we have the ability to add the contracts in here. So I've added a couple. I'm just going to go to this one here. We're going to show you what it looks like. So we've got a test contract on canola, going to Viterra. The already contracted bushels is 0. We're going to do 1,600 bushels here. So that's 160 acres. We're doing 10 bushels an acre, 1,600 bushels. We're saying the futures price is $14.50. We're going to say the net price $14.25. It's on November. So for canola, we just use November and January futures. For red spring wheat, we use September and December. Those are the only months we're using for this pilot project. Delivery window, so we picked that here. I got September. Contract date, we'll just say it's going to be, I'm just going to leave it when it was first put in there, something like that. And then the contract value, I guess I changed that now, so that's going to be 14.25 times 1,600, 27.6. Oh, got the wrong 14. My thumbs are too fat. 14.25 times 1,600, 22.8. 22.8. Great. So then we update contract. It's in the system now. Get pricing. It's basically instantaneous. Boom. There it is. So we got the crop. Some basics about the information I put on the contract. We got the price per bushel, the upper yield trigger, so that this establishes the band. The total acres is 160, and the price in this case is 29 cents a bushel. And that works out to $2.89 an acre. There's a summary on the right. So the max payable is $23,200. So if we want to do another contract, so we're doing this one. So we're saying in this case, we've already contracted 1,600. We're going to do another 800. Let's say it's the same prices, same futures, same net price. Delivery window, say it's October. Contract period, May 1. Price on that one. So we got 14.25 times 800. 11.4. Big contract. Get pricing. So the pricing on this one, same price, 29 cents a bushel. We got the upper trigger of 2,400 bushels, the lower of 1,600, 160 acres, 29 cents a bushel, $1.44 an acre. It's less because we're talking less bushels here, right? We're only contracting 800 bushels instead of the 1,600. Okay, so that gives you an idea. It's very quick. We need the particulars on the contracts. In the absence of that, like to get call it an indicative pricing, we can make some assumptions, right? We can say, okay, maybe you've already contracted 10 bushels. The next 10 bushels is going to cost this, right? And it'll be like an indicative price. The actual price, it'll be like whatever your contract amount is and when you try and get it. If you try and get a price tomorrow, it might be a bit of a different price. But the indicative price will be close. It's not going to change radically. So I'm going to go back to the presentation here. Let me know if you can see it.
Again.
Okay. All right. So yeah, if there's any questions on that, put them in the chat. I basically covered these screens off here. So now I'm just going to walk you through if we keep going, keep doing the 5 bushels, the 800 bushels, the 800 bushels with different contracts. The pricing, now this is real pricing for that farm. Here's the futures price, here's the net price. Go to the next screen, I'll show you what the pricing turns out at. So in that first band, as we discussed, 29 cents a bushel, that works at $2.90 an acre. The next band, 29 cents, $1.45. Then the next band, that's getting you from 30% to 40% protected. That's prices going up now. It's starting to get in, there's some material risk at that level. Now we're talking 43 cents a bushel. The next band going from 40 to 50, 66 cents a bushel. From 50 to 60%, now we're talking about $1 a bushel, right? So as you get closer to your expected yield, then the price goes up, which is what you would expect. Then I converted it to total dollars per acre here on the right, kind of basically adding up these prices here. So the benefits of ForwardProtect. So growers can forward contract with less risk. So in my scenario, when I was off for the week with the family, I could have contracted another 5-10 bushels, knowing that the most risk I would be taking on would be whatever that basis might do, right? The futures would have been hedged. Grain companies can get more profitable grain contracted, hopefully profitable, right? If you can do more in advance, hopefully that's a better situation. Advisors have more concrete information to work with. So now, instead of kind of speculating what the price is going to be in November, December, January, when some of that consulting happens, you got concrete information. It's a simple product with high coverage options, right? We can go up to 70% of the expected yield, and it's a product focused specifically on protecting this risk. It's not lumped in with a whole bunch of other products. It's not bundled in with other guarantee products, or you got to deliver to a certain location. There's no ties with it. You can deliver to any grain company you wish. So to get price indications, we just need basic farm information, contact info, what the crop is, what's seeded, how many acres, where are the fields. We need just that basic information, and then we can get some pricing. To get binding insurance, we need to know what your grain contracts are, right? Because if we don't have that right, then we're setting the band up wrong. We're not establishing it at the right level. So we need to know how much new crop you have contracted. And then we also need to know, if you haven't been working with us as a grower, then what's your provincial expected yields? We need that information too. So just to sum up, this is a pilot. We're rolling it out now. It's June 30th deadline, so we have a bit of time. It's simple. We're just ensuring the futures price. There's flexibility with the bands. The grower can not insure the first 10 bushels or the first 20. They can just start adding in the insurance later if they wish. There's delivery flexibility. They can deal with whichever grain buyer they wish. And there's limited capacity. We can't, just load up heavy in one area. We have allocations or limits per geography. And then we're only looking at canola and wheat for this year. Time frames, June 30th for signups. We require a seeded acreage report at that time as well. Crop check beginning of August, just to get an idea of how the crops are looking. Expected claim, as soon as you think you might be in a claim, where the yield might be below the upper band, then we need to know about it. So basically just keep us informed, and then we need the harvest report at the end of the day. So next steps, just create awareness as growers, have conversations with us about different scenarios. We can get a bit of a feel on how the pricing is in a certain geography for a certain grower. We need crop plans, grain contracts, government expected yields. Have that information ready to go, because if as you know, the markets they hit quickly, right? So but want to be prepared. It's like, okay, all of a sudden there's a whole bunch of contracting. We're going to be busy probably at that same time, right? So the more of this pre-work that can be done in advance, then the quicker we're going to move. And we're going to respond to growers and situations where we have more of that information, right? So I would highly recommend getting the crop plans in, getting the grain contracts in, getting expected yields in, just so we can move quickly when the time comes. And that's a wrap. Any questions?
If there are any, feel free to just throw it in that chat and then we will get to them. But if not, no, it was great, John. Any parting words from our team?
I would just open it up if anybody, even if you don't have questions, if you have comments. I think it's, really important when we're, building something new like this, as much feedback that we can get as possible is, quite helpful.
That's a really good point too. And even if you're not comfortable putting it in the chat here, feel free to send us an email afterwards. That is the whole goal of this pilot, is to take as much feedback as we can and keep iterating and keep improving it. Yeah, you can reach out to me, reach out to John.
The other thing I would just add from like, some of the, the team, the group on the call today, you're probably more familiar with the amount of time and effort that goes into generating a quote for crop insurance. So this is, as John tried to, demonstrate today, it's relatively easy. It's very quick. Especially if you're already a customer on the Agi3 platform, it's meant to be instantaneous. Just, those kind of few pieces of information. So, we encourage, don't think that, it's quite as lengthy as some of the crop insurance processes. I see there's one question.
Yeah, and for
here.
yes, we will be sending this out. And so everybody here today will get a copy. And then for some who weren't able to make it, we will send one out as well. And one thing we didn't touch on too is for the crops, we are going to include canola IP this year.
Mm-hmm.
Okay, I think that looks like that's it.
Perfect. Well, thanks everybody. Appreciate
Thanks,
the
John.
time.
I want to thank everybody
Thanks,
again.
everyone.
Take care.
Thanks, everyone.
Thanks.